listed down that if there are transactions only involving capital nature related assets or any business transactions, they will not be required to be subject to any TP provisions. However, companies are required to substantiate their basis for treating the capital gain or the loss or any other deduction. There's why they are saying that they are purely capital in nature and not uh, operating in nature. And that has to be, the position has to be consistent with both the tax return as well as the transfer pricing. So taking for an example, if we have a situation where there is a loan being provided, now depending upon the nature of the loan, how what are the the characteristics of the loan arrangement, whether it's a actual and capital loan or it's an advance or an equity kind of a situation. Depending upon these kind of assets, if it's a pure cash advance, then the transfer pricing provisions will differently apply. If it's a pure operating or a working capital loan, then TP provisions will of course apply and has to be analyzed differently. If it's a pure equity uh, contribution or an equity share capital, then TP provision will not apply. If it's a hybrid kind of a situation, it's involving debt and equity, then again that has to be analyzed. So these are some of the examples wherein depending upon the nature of the capital transaction, it has to be very clearly proven that they are pure capital transactions, not impacting the P&L at all, and they are consistent with the position taken by the company in its tax returns. So if there is any mismatch, then the IRS will definitely question those transactions more, and they have obviously the power to either accept it or reject it. So these are the first two key amendments made in the guidelines. Uh, Moving on, there is a small revision of a surcharge following the revision of TP adjustments. So IRS has, clarified that if there is any kind of potential, dispute or any issue with the tax company and the IRS, that the IRS has certain observations or certain view on a particular transactions analysis, and the taxpayer has conducted it differently, and eventually there will be some kind of a TP adjustment provision by the IRAS. So notwithstanding the company may not agree, the IRAS will issue the assessment whether a surcharge will apply or not. Because obviously, this is a little bit of legislative amendment, but there will be a surcharge. So bottom line is that if the analysis has been conducted properly and it can be explained to the IRS that this is the correct way of doing, there are chances that obviously the TP adjustment will not apply. That will be more kind of an aggressive situation when the company has not prepared anything or the analysis is absolutely incorrect depending upon the facts. But yes, at the same time, they have given this benefit to the taxpayer that after the conclusion of the IRS objection and the appeal process, which is a very welcome sign that they have given the full opportunity and the window to the taxpayer and their consultant that you have the right to give your objections to their assessment. And if after the appeal process, if the adjustments gets quashed or reduced or deleted, then obviously the surcharge will either not be applied or it will be adjusted, accordingly. But this is one amendment which they have given that to encourage companies to have in place a proper TP analysis and not just leave it at the end of the day. And when the IRS comes knocking on the doors, then the situation becomes a very difficult and a very complex kind of a situation to manage and salvage it. Uh, then coming on to the fourth amendment is the strict pass-through cost. So previously, and as the name suggests, strict pass-through cost was primarily that there was no value addition by the company in the entire transactional arrangement. So one of the examples could be that the company incurred certain expenditures towards the related parties, uh, towards third parties, and subsequently it got it reimbursed from its related party. So it's a pure vanilla kind of cost to cost transaction kind of situation, which are again also known as pass through costs. So there is no impact on the P&L on these kind of costs. So for earlier for pass through costs, it was one of the argument taken by some of the taxpayers in the past that we will just submit invoices. So invoices in the meaning invoices raised by the third parties and the invoices raised to the related parties to show a cost to cost transaction. So the IRS has clarified that for pass through cost, invoices will not be considered, as a written agreement. So in the past, it was being done that invoices were trying to be submitted to the IRS in the case of an audit, that they were agreements, but an invoice will not be considered as an agreement. So that is what now they have very clearly put it in the black and white, that invoices will not be considered as any agreements. If you have a formal written agreement, or if even if you have a proper email correspondence which is showing and depicting and reflecting the exact nature of the pass through costs, that will also suffice. But obviously that needs to very clearly detailed down the nature of the expenses. The amounts are very important. It's because the moment the amounts get changed or they show that they are not cost to cost, then the situation changes and then they are not pass through costs. So as long as there's a proper email communication or a formal agreement which explains the nature of these pass through costs and why they are being shown as a pass through cost, that will suffice. Now, related to these, there's obviously one point which needs to be very carefully analyzed, that the arrangement or the nature of the pass-through cost should also be shown very clearly or very mentioned very accurately in the audit report. Because based on our experience, what we have seen is that it has happened sometimes that the auditor has classified pass-through cost as services, and the moment they classify them as services, then it becomes a question of whether what is the markup to be charged and how much are the markup to be charged. Because the moment there is a services, there will be an element of certain element of markup, right? So it is to be ensured that the auditor is classifying these pass-through costs as actual pass-through costs and not services in the P&L or in the RPT schedule, to ensure that there is no further questioning by the IRS, because then their first line of defense will be the audit report. And if the audit report says that these are services, then that complicates the situation a lot. So that is something which has to be taken also due into consideration, apart from the fact that there has to be a formal agreement or at least some kind of email correspondence. Uh, then comes to the point related to intergroup financing. So this was something which I was just talking about, that there has now been a new paragraph which has been inserted, which clarifies the distinction between the debt and the equity in intergroup financing. So primarily, uh, there should ideally not be any hybrid kind of an capital instrument or any financial instrument or a financing arrangement which has both debt and equity, elements. That becomes a hybrid element, and that kind of arrangement generally leads to a tax avoidance agreements or arrangements, because this point is obviously taken a cue from the OECD different chapters 1 to 15, wherein chapter one of the chapters does talk about hybrid instruments, right, or hybrid mismatch agreements in BEPS 1.0 action plans. And this specific amendment has been taken from that action plan, that a hybrid kind of an instrument or a complex financial instrument financing arrangement, wherein it has, there are certain provisions that after a certain point of time, the equity share capital can be converted into debt or vice versa, or uh, the instrument is like that from an equity share capital becomes a preference share capital. So any kind of hybrid instrument or any kind of arrangement which has different financing arrangements will lead to a fact that there is a kind of instance of a tax avoidance issue. And that's why the IRS has very clearly mentioned that there has to be a clear distinction and demarcation, that whether the intragroup financing is purely related to debt or purely related to equity, again depending on the fact and relating to the point that whether it is impacting the P&L or the balance sheet. And similarly, companies must ensure that there is no hybrid kind of an instrument. Even if it is there, the terms and the conditions of and the financial covenants of the related parties and the Singapore entity needs to be very clearly delineated, that if it is a hybrid instrument, what is the role and the responsibilities of the related parties when the instrument will be considered as debt and when it will be considered as equity. So to to reduce the complexity, it's obviously advisable not to have a kind of hybrid kind of an instrument, which will complicate the matter more. But if at all the arrangement needs to be have in place, the distinction between the financial parameters have to be very clearly mentioned in the agreement. Uh, Now coming on to the intercompany loans. So this was obviously an amendment made by the IRAS in the previous guidelines also, that an interest rate free mechanism will not be accepted. Now they have clarified further that apart from this, that the interest free rate mechanism, so whether it is exceeding the thresholds of 15 million principal amount for the loan or less than 15 million, there has to be an interest rate. So that is something which is unavoidable. Interest free rate mechanism will never be accepted now. Now, what they have further clarified, that apart from 1st of January 2025 onwards, if both the lending and the borrowing party are not in the business, of borrowing or lending, or they are not into a banking or any financial services, they can simply apply the IRS indicative margin or determine the interest rate depending upon the principal loan amount by way of a proper database-based benchmarking analysis. But they also need to very clearly mention in the transfer pricing documentation as to what is the methodology and the approach which they have taken for determining the intercompany interest rate. So the bottom line is that they have to have in place a basic level of analysis and a basic level of documentation. If it is not a full-fledged or a detailed documentation, a basic level of a memo which captures the details of the intercompany loan transactions and how the interest rate has been determined. So apart from this point which we have mentioned here, the other key element of their update is that as long as the company has properly conducted a proper benchmarking analysis, it can even prepare a small sort of kind of a memo. It doesn't need to have a full-fledged documentation. It can be a simplified or a memo which captures the details, but it should not be that the company has just done an interest rate analysis and the matter stops there. So first is interest free is completely out of the question. You need to have an interest rate analysis, and on the basis of that, you can either prepare a simplified version or a full version or at least a memo which captures the details of the transaction. And related to that, there also needs to have a proper in place an intercompany agreement, because that also helps to a large extent as to determine the interest rate. So intercompany agreement, interest rate analysis, and at least a basic level of documentation is definitely needed for intercompany loans primarily. Uh, the The last and the most newest amendment is the simplified and the streamlined approach for baseline marketing and distribution activities. Now, this is uh, purely taking reference from the OECD BEPS pillar 2, right? And in pillar 2, we have two, pillar 1 and pillar 2. And pillar 1 has two amounts A and amount B. So pillar 1 uh, has certain thresholds. Pillar 2 has certain thresholds. Pillar 1 is basically talking about the the in a layman terms, it's talking about the profits split between the key entities, the residual entities, and the low value adding entities. And pillar 2, which is the most hot topic now, is towards the minimum effective tax rate of 15%. Now in pillar 1 of BEPS 2.0 program, there is an amount B issued by the OECD, which talks about certain simplified and streamlined approach for the baseline marketing and distribution activities. So this obviously depends on various qualifying conditions, because only companies who are performing the specifically identified and mentioned baseline marketing and distribution activities, they can only apply this approach. So, but obviously to keep into pace with the global developments, the IRS has now introduced this a new section, and it has called this as an optional SSA, streamlined, simplified and streamlined approach on a pilot basis. So it's not a formal, it's on a test check on a pilot basis from 1st of January 2026 uh, till 31st of December. So this is a pilot on a test period which they are using, but at least it's a welcome sign that they are trying to keep it pace with the BEPS 2.0, which obviously is still undergoing a lot of changes, a lot of global developments. But as of now, this is why, and that's why this is a pilot approach. It's not a formal approach. So for any financial year falling within this period, which will obviously start from this year. So, but we have to first of all take care of financial year 2025. But